Okay folks, welcome back. Alright, so this is price action model number 6, universal trading model, and we're going to be specifically dealing with the buy side low resistance liquidity runs and fractals. Okay, for the stage we're going to be looking for a liquidity draw. The setup is going to be a buy side of a market maker profile. And the pattern is going to be fair value. Okay, so buy side low resistance liquidity runs with fractals. Okay, the buy side expansion. The market maker sell model, we're going to be focusing on that initially. So in the chart, and this can be in any time frame. Now before I get into it, just let me preface it by saying that the things I'm going to be discussing here are not new to you. Okay, so we're not redoing the mentorship. What I'm trying to do is convey the ideas, how I go into the charts personally, and arrive at the setups that you guys see me do on a weekly basis. So when we do our weekly commentary, I'm highlighting the levels at which I'm interested in, or maybe a directional bias I want to focus on primarily. But the key levels are really what I want you to be studying, and then also go back in hindsight and look at what we've seen in post price action, in other words, after those levels have been traded too. And not only does it pan out like we were anticipating relative to the commentary, or if it fails, but when it does pan out, what is it actually delivering in terms of price? Okay, and I think what you're going to see here is really the core of which model I trade mostly, okay, because I see when dealing with the mentorship and the things I share publicly. So when you understand this, it allows you to be a universal trader. In other words, when I say universal, it doesn't mean you're day trading, scalping, and swing trading all at the same time. I guess that would be the highest order of doing it. But what I mean by universal is that you can find a setup, and I want to be very careful when I say this because I don't want you to feel that I'm inviting you to overtrade, okay, or force a setup. But if the setup is there, you should be able to identify it and highlight it in your price action. Okay, so let me restart this. So when the chart, again, this is any time frame, presents us a bullish condition for a market, we have to understand when the market is poised to move higher based on a draw on liquidity. Between the moment and price, we identify the liquidity the market will seek and the price level of the targeted liquidity. This is our range of opportunity. In this case, we have a level above us, okay, and this is obviously with the benefit of hindsight in our crude depiction of price action here, but we are going to assume that we have some inkling that the market's going to want to trade up to that level. Now that level relative to whatever time frame you're looking at could be a bearish order block, it could be a run above a previous high, it could be a liquidity void or fair value gap that needs to be filled in during a deeper retracement. Whatever that level is, or premium array, it's going to be up to you to frame out, okay, because obviously you could be a scalper, you could be a day trader, you could be a short-term trader, one shot, one kill, a swing trader, or a long-term position trader. All of those styles or methods of trading can be accomplished by this model. Okay, now when I say this model, it's assuming, again, like we do with most of the models so far, is I'm kind of giving you more of my personal opinions and slants on the approaches themselves. With that, I'm going to kind of give you what I do on a week-to-week basis, and then if I don't see my weekly analysis pan out, or I do see it pan out, what am I actually doing to work in a pattern or a setup? So with that assumption that we have a liquidity draw, okay, above us in the form of a premium array, it doesn't matter what time frame it is, okay, so kind of like suspend that that need to know that, okay, because I know you're probably saying, well, what time frame is this, Michael? Okay, it's any time frame, any time frame whatsoever. And I'll go into the charts and I'll show you some things with it, obviously, once we go through the theory of it. But the draw on liquidity is going to be above us, so we're anticipating a run-up in price or building in of a premium, okay? And then the beginnings of the move may not be clear to you, okay? But hold that for right now. But the beginning of the move generally will be some measure of bullishness. Now, it could be the end of a existing bullish trend. It may be a consolidation that finally breaks out, or it could be an altogether reversal, okay? It's not apparent or needed to know that right now. We're just looking for a point at which the market's going to build in a premium or rally up, okay? That range of opportunity is seen here. So when we first identify the range at which the market should build in a premium or trade higher, in other words, in layman's terms, up to our predefined draw on liquidity, okay, to a premium array. You may not see that initial buy at the large green arrow, but after the initial move higher, your eyes should, based on all the examples you've seen in the mentorship and through your own study of price action, you should be able to see this as a potential buy. So buy point number one, that first retracement, it may or may not come back to an area of the original consolidation if it is allowing that. That first retracement could be a retracement back into a fair value gap inside that first leg up, or it could be an order block that it trades down into. You have to use your PD array matrix, but that buy should be the one that you're able to see initially, even if you don't catch the initial beginnings of the upside move. And then obviously there's always the likelihood of a secondary retracement that allows for more buying or a buying entry that you have missed on the previous two instances, with an expectation that it runs up into that liquidity. If this were a daily chart, this could be the setup that takes place over 1 or 2 days. Okay, so these impulses from point number 1 up to the high between point number 1 and 2, that may be 1 or 2 days to transpire. And then we have a retracement of 1 day, and then the weekly expansion continues, and we get the high of the week as it reaches into that liquidity pool. If this were a daily chart from an intraday perspective, rather, in other words, say it's a 15-minute time frame, this could be an Asian range, false break lower, and the market rallies up again in New York and has a market reversal in the New York session or London close session, and then the day reverses and trades lower. If this were a weekly chart, okay, we could have a long-term consolidation that sees a impulse leg that moves higher, and the market trades for several weeks higher and retraces back down. That point number 1 would become an ideal scenario for long-term position entry or a swing trade. If you miss the 1 point and it starts to rally up, and again, this is a weekly chart, the retracement back to point 2, which would be a discount array, okay, relative to the range that would be created looking at the price action. Again, this is a very crude depiction. It's only a little line drawing I made in my computer just to communicate the idea or theory.